Hi everyone, we're just going to wait maybe one more minute while we give time people to log on. Just a few more seconds and then we can get going. Okay, well, we're on 2 minutes past the hour, so let's maybe start. So hello everybody and welcome. My name is Phil Tiley, and thanks everyone for dialing into today's webinar. I think we've got over 1,000 people, well over 1,200 people actually registered for today's call. So delighted for the interest in our analysis. And today I'm delighted to be joined by Alex Jaffe, who stepped in this time for Robbie Tangen. Alex is a senior director at Altus, works with a number of our key client accounts. So hi there, Alex, and thanks very much for joining us today.
Phil, thanks for inviting me. Look forward to the discussion over the next hour. But apparently I missed the wardrobe memo for my lapel. So maybe Phil, could you comment on that? And then we can certainly jump into the numbers here.
Okay, yeah. The poppy is to commemorate Armistice Day. And it's in remembrance of all the soldiers and civilians that have died initially in armed conflict in World War I, but it's been extended out to commemorate and acknowledge, remember anybody that's died in armed conflict or soldiers or civilians since World War I. And it's a poppy because after the First World War, the battlefields were covered with poppies. So there you go, there's a bit of a history lesson up front for you. Okay, before we thanks, Alice. Before we get stuck into the results, just to clarify, we're going through the Odyssey Index. So these numbers are based on all 25 Odyssey funds, and within Altus, we have a valuation data set of over 180 portfolios. We match up those Odyssey funds that we work on with that data set to provide added intel onto the analysis using the kind of the valuation metrics. The webinar is partly market insight for our wider client base. It's partly a precursor to the conversations that we have with clients where we repeat this analysis on a comparative basis. As always, want to just stress this is a collective effort pulling all this together. So thanks everybody for kind of getting involved in this process. My performance team that sits alongside me, the wider advisory business unit who work with our clients' data, and obviously our clients in particular for giving us privileged access to their data. Before we get into the detail, we obviously just remind you of a few polling questions as we go through. There's a chat box, so put the questions you have as we go through things in the chat box. We'll run some polling questions as we go through this, and maybe over to you, Alex, with just the first of those, just to recap on where we finished off last quarter, really.
Sure. So last quarter, we polled the group, and the question was, what did they anticipate the 3Q Odyssey return? Majority indicated between -2% and +1%, or -4 and -2. So Phil, that was the estimate last quarter for the group. How did we do, or how was the forecast turn out in third quarter?
Okay, well, most people were in the right ballpark, so let's move on. And you see on the right-hand side, the return did come out -1.4% for Q3. And I thought I'd start with this kind of simple linear illustration of the returns from the Odyssey, date back just for the pandemic. And just to clarify, what we're looking at here is the pure real estate part of the Odyssey. So there's no leverage in this, no cash, no fees. So we're looking at how actual real estate performance levels are played out. So that result for Q3 confirms that the market is still very much in decline. That's now the fourth consecutive negative rate of return. Compare that with the onset of the pandemic, when returns just turned negative for one quarter before embarking on this kind of unprecedented growth period, during which record performance levels reached record levels of almost 7% there. But the performance of real estate is now very much being pulled back, pegged down through this, call it, ongoing period of contraction, I guess, Alex. I assume that will come no surprise to the folks that are tuning into this call and watching over the market, given the continued uncertainty around the economic backdrop. Couple that with the ongoing elevated cost of capital, which as a collective is putting a downward pressure on the market. So maybe Alex, up front, your thoughts on those overall return levels that have shaken out this quarter.
Sure. I think the first thing to note is that the returns are negative and remain negative, or put differently, the values continue to decline further. That's really a function of the increased cost of capital. We're seeing it in treasury yields, we're seeing it in term premiums. The second major theme that has creeped in is geopolitical uncertainty around the globe. And really the third thing, what we're seeing on the appraisal side, is more and more price discovery. And really those prices or values are coming in lower than previously marked. So really a combination of those three things continue to drive the returns negative and further quarter to quarter.
Thanks, Alex. So let's put a few more numbers around that. First off, top right-hand corner, the level of decline did ease, so minus 1.4 compares to minus 2% in the prior quarter. And that, as in prior quarters, within that, there's the mix of the results that are being played out across the sectors. So in terms of the rank order, we're color coding those sectors as to whether they're north or south of the ODCE overall operating asset return. That actually comes out the same as the overall return. So development properties, which are included between those two, aren't really moving the needle at the moment. You look at the rank order, no surprise that offices continue to be the outlier. They remain firmly rooted to the bottom of the stack, although kind of the decline has slowed from minus 7.3 to minus 4.5, whereas apartments and office returns have gone the other way. They've dropped off a shade from where they were at the midpoint of the year. Apartments just falling below the ODCE average. Industrials kind of still holding out comparatively well. Other and retails are on a slight upwards trajectory, improving over the quarter. Other, the largest share of which, just to clarify, is still self-storage. That's with a net zero return. The retail return turning positive there at 0.3, but just to stress, there's still negative returns in both those numbers. And something we've been reporting on prior quarters at the bottom of this chart is the spread in returns or performance levels across the sectors. And so we're starting to see a little bit more convergence now across the sectors as the pace of decline has slowed. And what this convergence for me serves to emphasize is really the level of uncertainty that I guess is pervading all parts of the real estate market at the moment, with no one property type really pushing ahead with any real positive price discovery at the moment. If you look at that visually, you can see the convergence better on this next chart. Contrast this here, the now, with the kind of double-digit spreads that we were seeing playing out during that growth period when industrials were simply racing ahead of everything else. We're not quite back at that kind of comparatively narrow range that we saw going into the pandemic. And in terms of kind of changing the guard, it's now offices that are languishing at the bottom end, whereas previously it was the retail sector back here that was being called into question. Let's get back to the all property numbers, which we're unpacking here into the green, the income, and the appreciation elements, putting kind of the recent kind of period in a 10-year context. From an appreciation standpoint, the red bars, if we break the recent trends into three distinct periods there, you have that write down at the onset of the pandemic, which looks kind of relatively minor in the wider scheme of things, values down just 2.5% then. That was followed by then 7 consecutive periods of growth, during which just shy of 23% was added to property values. Then we enter the current period of correction, during which values so far have dropped by 13.5%. That level of decline is gradually tapering off, but it doesn't appear to be going away fast. So maybe on that point, we should open up one of our first polling questions there, Alex.
Sure. So question to the audience is, when will value declines reach a bottom or trough? First selection is end of year 23. Second selection is first half of 24. Third selection is second half of 24, or the last option is 2025 and beyond. So Phil, from your crystal ball, do you have a sentiment or idea for when you think values will stop declining, or we will reach the bottom?
I could cop out and say, I guess different sectors will get there at different times, but I suspect it won't be A in my mindset. I'd be more tilting towards the C bracket there, maybe. Maybe B if we're trying to be a bit more optimistic.
Okay. So it looks like we have the results that came in. 37% indicated first half of 24. And then Phil, to your point, the majority, 53%, indicated second half of 24. So it looks like it's heavily skewed to 24. And then it's just a question of what time period in 24 will value declines reach a bottom.
Okay, well, thanks everyone for giving us your thoughts on that one. And kind of following on from that question, if we use the kind of the onset of the pandemic 15 quarters ago as a strategic marker, this bar here, it illustrates the fact that values are still north 3.5% ahead of where they were pre-COVID. If we look at that value change here across the sectors, compare that kind of period of time with what's played out in the sandbars over the last 12 months, see a very different set of results playing out across the sectors here. Just to throw some numbers down, office values are down almost 30% since the start of the pandemic, and most of that decline from that sandbar you can see coming through in the last 12 months. Retail values are down around 18%, and only a smaller part of that is recent, so most of that decline was at the start of COVID. Industrial values up a staggering 60 percentage points over that period. So those recent reductions of almost 10% are pretty much a minor blip when you put that into context. But I guess, Alex, what this shows foremost is just how polarized the market has been. You've got a near 90 percentage point swing there from the top end to the bottom end, and these are just averages, I guess. So maybe your thoughts around that.
Yeah, so echo or underline everything you said about the polarization by the sectors. But I think the other thing this is showing is really the benefits of a diversified fund. So as you call out, Phil, on the right, we are showing all properties appreciated 3.5% since the onset of COVID, one of the most turbulent times, positive and negative. And despite all that, appreciation is 3.5. And just as a reminder, this is only the appreciation component, is excluding the income component per quarter. So on average, it's 1% per quarter. So again, I think this speaks to sort of the strength or the diversification in a core fund, and the reason that it has performed over a interesting 15 quarters.
Definite point well made, Alex. Thanks very much. Let's return to that prior chart. So where it gets interesting is when you look at the makeup of the appreciation. So what we're able to unravel at Altus using our extensive valuation data set, try to get to an understanding of how much this movement in value is the product of the pure economic fundamentals versus what might be termed the investor sentiment or the capital market size. So first off, we transfer the red bars to be the red line. And then here we bifurcate that appreciation red line into what's termed the yield versus the cash flow drivers. And so folks hopefully will be getting familiar that have dialed into this call on a regular basis. But the yield, the yellow, is how much the value movement is dictated by the change in actual valuation yield. So that's movements in discount rates and exit caps. The cash flow, the blue bar, is the impact on values from the change in the forward projected cash flows that are effectively being priced by those yields. And you can, what we're seeing, if you look to the right-hand side here, is that the makeup of the appreciation or the value decline hasn't really altered a great deal in terms of its structural setup over the last 3 quarters. It's those yield increases that continue to pull back on values as the market adjusts to that increased cost of capital environment. But what for me is kind of almost as important, just as important to note, is the value change standpoint is that is now kind of coinciding with a somewhat fallow period when it comes to the cash flow side of the equation. So if you look back over the history of the chart, it's predominantly the cash flows, the blue bars, that have created value for real estate. They were certainly the major underpinning of growth during this kind of period of escalating returns. And more recently, they were providing some protection against those early rate rises, but those gains have eroded away, or put another way, come to a standstill, which means that the market is now really feeling the full effects of those rate increases. And I guess that rather muted cash flow outlook, I guess, is reflective of that kind of uncertain economic backdrop that you were referencing before there, Alex. So maybe get your thoughts on those specific levers there. That'd be great.
Yeah. So as you mentioned, Phil, we continue to see increased yields despite interest rate pauses. There's still 10-year Treasury is still elevated. Discussions with a number of institutions and clients have indicated that long-term expectations for borrowing beyond just the Treasury rates is elevated. We've loosely heard 4 to 5% over a 10-year holding period. And then I think the other thing we're seeing real time with acquisition or disposition activity is we're seeing higher implied yields to transact, not just in year 1 of the cash flow, but year 2, year 3, etc. So no surprise, but we continue to see the yields increase as the chart indicates. And then the other piece, we just want to remind the viewers, the cash flow position, or the blue bar, indicates the relative change period to period or quarter to quarter for these time series. So if the blue bar does not change, where as indicated in 2023 Q3, and I know we'll expand it further by sector and MSA, but if there's minimal change, that means there is no change from the forecast from Q2 to Q3. That does not mean there's no change in the forward-looking NOI. It just means that there's no change from the Q2 and 10-year NOI forecast to the Q3. Or put differently, there still may be embedded rent growth escalations in these forecasts. So in some ways, despite the cash flow effect being muted, there's still embedded growth in these assumptions, or it also acts as somewhat of an inflationary hedge. So Phil, just 2 points I want to clarify, what we're seeing on pricing, and then also the cash flow position, how to interpret that, not just period to period, but underlying as well.
Yeah, good point to stress there. And also the point of this is these are averages. So let's see how that detail shakes out across the sectors. So let's start with the top 2 charts here, apartments and industrials, the 2 kind of prior growth sectors, where those rate rises to continue to peg back value, and no change there in terms of the order of magnitude in that size, that yellow bar from the prior quarter. Industrials do have more of that protective buffer from those increases in cash flow trajectories, or that is starting to taper off in recent quarters. Apartments are on a similar trajectory, rate rise to the industrial sector, but now without any of that cash flow buffer here, revenue projections look to be coming to a bit of a standstill. Or just to pick up on Alex's point, there's still cash flow growth here. It's just no more so than it was in the prior quarters. There may be questions around affordability starting to creep into that apartment sector, leading to things taking a pause there. Bottom right, the retail sector is just about trending in the right direction. Rate rises are easing off. Cash flow projections are actually starting to edge back up. Actually, Cole Perry and our research team posted a couple of really insightful and quite positive articles around the retail sector. I encourage people who are dialing into this to go onto our website and give those research papers a read. They talk to increases in retail sales, but also to kind of reinventions of part of the retail sector, and how estimates suggest that the retail per square foot per capita is lower than any point since the aftermath of the GFC. So a sign that the retail sector is right-sizing, kind of rebalancing from a position of significant oversupply. You contrast that when you go across the offices, where there are clear concerns now about there being maybe too much product and how some of that product needs to evolve. So given the change in the working practices, and that's inevitably being putting downward pressure on those cash flows, and it's that in addition to those rate rises that's keeping the office sector at the bottom of the stack. We quickly substitute to that top right-hand side the industrials for the other, just to complete the suite of property types. So most predominant part of this is self-storage. Rate rises continue to peg back values there, although here that cash flow trajectory is picking up. provided a little bit more protection to those values coming closer to a standstill there. As we dig into these trends in a bit more detail, we want to both consider what's happening in most recent quarters, but also frame that within how these levels have been playing out since the start of the pandemic, so taking results back 4 years. In terms of the near term, and just sticking with the Q3 numbers, that's your appreciation results on the left-hand side for the current quarter. The sectors are ranked in order. The appreciation is broken then into the yield and the cash flow variances. This is just Q3, and it's yields, the orange bars, that were clearly doing the damage. But the cash flows are playing into the hierarchy, or certainly separating offices from the rest, and now with no further gain, putting apartments lower down the order. If we then look at that on a 4-year basis, now these are annualized metrics, so that's what's that, about a 20% per annum annualized spread in appreciation. You can see that yields are taking away value in all those sectors, with the exception of other. But it's the cash flows that have had the far biggest bearing on those appreciation levels. And I guess whatever way you look at these numbers, Alex, it feels that as if the rate changes are really what's been dominating the narrative. So maybe we should start and dig into that yield effect first and look at how pricing levels have played out across the sectors. So maybe you just want to pick up on the narrative around this slide here, Alex.
Sure. So thanks, Phil. So the other way we wanted to look at the pricing metrics is not quarter to quarter or in total over the 4-year period, but we really wanted to look at different snapshots or points in time. Really, this is pre-pandemic to where we are today. And so I think the first thing to note is that all pricing metrics for all product types are higher in 2023 Q3 than they were in 2019 Q4. So I think that's observation number one, and that's despite very low metrics in 2022 Q1. So all metrics are elevated. Again, I know we've touched on it a number of times for the reasons, and we continue to see those in the underlying cash flows or underlying discounted cash flow models, but all metrics are elevated. The other thing we wanted to call out here, aside from office, is the trend. In the trend is that it looks like all product types, less office, are converging, or they're being grouped together in 2023. We saw a similar central pricing metrics that we saw in 2019. Again, there are slight variations by product type, but it was much wider, the spread in metrics, if you look at during 21, and it looks like all the metrics are now converging, again, not on top of each other, but much closer than where they were in 21 versus 23. So Phil, those are high-level pricing observations. Can I pass back over to you for understanding the cash flow metrics?
Okay, thanks, Alex. Yeah, so on that, we return now to the cash flow side of the equation, which has effectively kind of come to a bit of a standstill, but there for the last quarter, and this is just for the 3 months. But there is different kind of makeup across the sectors. And in terms to understand that cash flow piece, we kind of open this up into a series of key valuation metrics. The bars show the percentage change in those metrics over the quarter. There's no perfect science to this, so you can't sum these components up to the cash flow effect, but the color coding gives you a sense of what's having a positive or a negative impact on those forward projected cash flows. So mixed sets of results across the sectors. Start off with occupancy, where levels are up for retail and in that other grouping. They're down for offices, so that kind of fits in with the rank order on the left, which is the appreciation rank order. Contract rents and market rents in the green, they're moving in the right direction. Though for offices, that's pretty static. And those market rents are being kind of scaled back or pegged back by those reductions in those forward projected growth rate assumptions. These are 10-year average growth rate assumptions, and how much they've altered over the quarter. With a click, we can open that up into years 1, years 2, and years 3, and those adjustments in the 10-year, you can see a kind of both within the kind of year 1 and the year 2. I think if we look back at last quarter's presentation, most of that scaling back was just in year 1. So maybe concerns about kind of economic slowdown getting a little bit extended out now. If we think of the cash flow in terms of trade-off, I mean, the industrials have seen more meaningful increase in face market rents, and while growth rates have been factored down here, there's still a net positive trade-off when it comes to the cash flows. Offices, it's the reverse. There's no improvement in market rents. You've got the reductions in those forward projected revenues. The added pressure then for the offices comes from a mix of increased rent concessions and increases in operating expenses, which we're picking up under this year 1 operating expense ratio, which is a ratio of projected operating expense, the percentage of the gross revenue for the next year, and how that ratio has changed over the 3 months. So put another way, the cost of revenue carry for offices is increasing. And then crucially on the right-hand side here, you also then need to throw into the mix the additional capital that's being required or budgeted to be invested into specifically into those office assets to ensure they remain kind of fit for purpose or competitive in the wider real estate landscape. And that's currently putting a bit more downward pressure on those cash flows. If we look to that cash flow kind of aspect, when we look over the 4 years, it's then really a case of the haves up here versus the have-nots down here. So your industrials, your other sector, your apartments are all effectively better off cash flow wise than they were 4 years ago. Their market rents are up. Industrials notably so, up 70%. The growth rates are ahead of where they were. Offices and retails, though, on the other hand, have lost ground. Their rents haven't really moved a great deal further forward. Their growth rates are down, most notably on the office side, and you can see that cut back, almost 3 percentage points taken off that year 1 growth rate over the last 4 years in year 1. You have that increased cost to revenue carry, and also you have that kind of increased capital that is being provisioned into those sectors. I mean, you could observe that some of that additional capital for the retail sector now appears to be paying off as that sector has started to kind of provide slightly more robust performance numbers. So it'll be interesting to see how that then plays out for the office sector. We can also chart these metrics over time, and we're doing more of that on a comparative basis, and then we'll leave this slide in the deck, but I won't go into the detail too much. It's just a linear representation of these metrics. So you can see the levels which they rose to and which they came down. So for example, that capital cost piece really kind of picking up in the last few quarters when it comes to the offices. And this is just offices versus industrials, but we'll leave that for folks to go through at their leisure, and maybe close off the sector session with another polling question there, Alex.
Great. So the polling question number 2 is, which sector will hold out best over the next 12 months? Multifamily, industrial, storage, retail, or office? Phil, do you have a guess as to which sector you think will hold out best or be the most resilient over the next 12 months?
I quite like what I'm reading about aspects of the retail sector at the moment, and going to those research pieces. I think you can't rule out industrials. They always seem to be the sector that kind of never fails to surprise on the upside. So yeah, maybe somewhere between those two.
Retail, industrial. Are we able to see the results just came in? So 45% selected industrial, and then 24% selected retail. So Phil, you similar to your thoughts, and then also to note 17% selected storage, 0% selected office. I don't know if that's a surprise or not, but maybe I know we'll jump into each sector here a bit deeper dive, but looks like again industrial and retail are the projected to be the better sectors for the next 12 months.
Excellent. Well, thanks everyone for participating in that poll again. And yeah, let's get into the detail of those sectors to see how. Well, first off, the returns are shaken out on a geographic basis. So let's, as the title said, let's start with the apartment sector first. So sorry, lots of colours, lots of numbers here. So just to navigate folks around the table, these are total returns for the last couple of quarters up top, for the last year below that, and then we're separating out the annualized 4-year returns below that to show you how those performance numbers are shaken out since the onset of the pandemic. The color coding is effectively what's ahead or behind those sector averages for each of those periods. So the first point to note, maybe up top, and we've mentioned this in the prior couple of quarters, is that we've been observing this kind of bit of an east-west tilt, or kind of a northwest tilt with those larger setbacks for the likes of Seattle and San Francisco. On the upside, Chicago starting to settle down, positive returns in each of the last couple of quarters, and some of the other larger kind of gateway, call them metro markets, you know, your New York, your DC, your Boston, also in the green, started to hold out comparatively well. If you kind of go back to that 4-year bar down the bottom, there's more of a clear-cut kind of power shift between the gateways being surpassed by the Sunbelt markets playing out there. But more recently, we're starting to see some of that unwind, not just with the kind of the settling down of some of the gateways, but also some of the larger setbacks here we're seeing there in Phoenix, and also in the other grouping that includes a number of those Sunbelt spots. So maybe, Alex, your read on that variant that we're seeing here.
Yeah, I would say, just to emphasize some of the themes you mentioned, Phil, we are seeing differences by MSA, and it's not necessarily simply a coastal or east-west story. As an example, if you look at the 4-year returns, Seattle and San Francisco, Oakland, and LA have underperformed, but interestingly enough, Inland Empire, San Diego have done well. So I think it's a bit too broad to say it's all of the West Coast. So we're seeing a divergence there. And then I think the other thing to pick up on, Phil, that you mentioned, is we are starting to see differences in the Sunbelt markets. Just 2 examples, especially in third quarter data. If you look at the Miami apartment, it is less negative. But if you look at the other apartment, it is minus 2.3. And so we're starting to see differences in some of the Sunbelt markets. I know Phoenix as well, we've seen that, but we're hearing more and more supply come online. And so we're starting to see some of those markets move significantly different. So maybe, Phil, pass back to you.
Yeah, and actually, if you open up those Q3 numbers just on this next slide and look at the appreciation levels and breaking that down into yield and the cash flow effects, it shows, first off, I guess, why some of those larger metros are now seeing kind of the lower levels of decline. And that's really courtesy of this improvement in the cash flow levels, which is taking the edge off some of that kind of increased cost of capital effect. And that improvement in cash flows can be traced to the fact that those market rents are registering more of an improvement there. I mean, those growth rates are pretty much down across the board. But where you couple that down below here with kind of little or no movement in market rents, then you can see there's less protection against those rate rises. And actually, to your point there about the supply side of things, into that other, which includes a number of those Sunbelt spots, and Phoenix, those market rents are net down for the quarter. So no doubt elements of oversupply starting to impact there, as you say, Alex. Let's pivot across to the industrial numbers. Again, the same order to the tables, Q3, Q2, 1 and 4 years. Looking at the top, the most negative kind of LA and Inland Empire. That's a kind of total transformation of where they sit over the 4 years. Worth noting that also, I think that a number of the markets up top here are starting to stabilize. So we're seeing a number of positive returns for the industrial sector up top, which is encouraging to see. Miami is the one that's really moving the needle, moving into the ascendancy over the last couple of quarters. They've actually now kind of emerged as an outperforming market. You look at 17.4 against a 17 on a 4-year basis, and yeah, in that 4-year, yeah, LA, Inland Empire, New York, New Jersey, just to confirm, they were very much the powerhouse of the industrial scene during that recent growth period. Now, if you just going to pit here Inland Empire against Miami, so just to show that different trajectories are playing out here. Inland Empire clearly went on this phenomenal growth spurt. Those cash flow kind of gains are starting to ease off, but those cash flows are still positive, so they're still increasing in terms of their projections, but just not the same order of magnitudes they were before. Whereas Miami is very much a market on the up. I mean, I think this slide just plays that whole point about how it's cash flows that really do create value for real estate, and no more is that apparent than what we've been seeing playing out in the industrial sector. And whereas Miami might not have hit the same heights as Inland Empire, it certainly looks like the rents are on the rise and have more to give. So maybe, Alex, your thoughts on the variance that we're seeing kind of across the geographies, but I know that you've also done a bit more analysis yourself, looking at kind of the lease variations as well, which certainly play into the industrial market, especially into that kind of hot topic of pricing. So maybe back over to you, Alex.
Sure. I think just real quick on the Inland Empire relative to Miami, I think the other thing to note, or what we've seen, is really some of the divergence of the port traffic from LA to the Eastern Seaboard. And so I think Miami's a clear beneficiary of that here as well. Right. So that may explain some of the, again, still positive cash flow positions for both markets, but why Miami seems to be growing faster as of Q3 because of that shift in the shipping area. But Phil, to your point, if we do move to the next slide, the other way we started to look at industrial is WALT, or weighted average lease term. And let me explain the chart. I know there's a lot of numbers on here, so apologies, but just explaining the chart, we have subdivided the industrial ODCE funds on the bottom based on average remaining lease term. So assets with 0 to 1 years left is the first bar, 1 to 2 is the second, 2 to 3 is the third, etc. Across the bottom then, so 1.84, 2.95, 3.38 is the implied year one cap rate by weighted average lease term. So these are all year one implied cap rates for industrial, but you can see the variation, whether there is 0 or 1 years left of lease term versus 7 or 8 years left of lease term, which is approximately 3.9 or 3.95. So there's significant variation amongst the remaining lease term. And then the other analytics we've run internally is for all of these assets, we've looked at not what just the year one implied rate is, but what these roll to, or when they move to market, so the next year. And as Phil is alluding to, all of the assets that expire in year one, they then roll in market to a 4.87 cap rate the following year when they lease up in the appraisal. And then in the second year, or plus 2 years after the roll, that 4.87 moves to a 5.64. So, and part of that difference is because of there could be free rent, there could still be some downtime, and so there's slight variation in timing. But really what we're trying to show is there's a clear difference in pricing or valuation based on weighted average lease term for industrial. That's number one, based on the grouping. The second comment we're making, and we do get this question a number of times, is the implied cap rate for ODCE Industrial is approximately 3.6. That's a function of the significant below market rent. And if you aggregate all these, or as we're showing, yes, the implied rate is 3.6, but it's closer to a 5.8 or 6% implied cap rate, assuming these leases were at market or once they roll to market. So again, just a different version of the analytics, but something we've been talking a lot about with our clients, not just the geographic lens for industrial, but also based on the weighted average lease term, based on the rollover, and then really what that market cap rate looks like for industrial, given the phenomenal cash flow growth that Phil has alluded to earlier in the presentation.
Yeah, thank you for that, Alex. Yeah, I know we had a lot of questions maybe that came in before quizzing around this, so that's most probably hopefully helpful insight for folks that have dialed in. And the lease term piece certainly plays into the performance metrics when we're talking to our clients and running through the comparative analysis, not just look at things on a pure geographic basis, but also looking at that lease term bit and how that influences those return levels. So hopefully that's helpful insight for folks that have dialed in today. Let's move on, if my slides will move. There we go. And let's turn our attention now to the offices. Clearly the most challenged sector, same order to those return series. Worst affected markets in recent quarters are the usual suspects in red: New York, DC, Chicago. That's consistent with those 4-year averages. More recently, we've seen increased challenges around those kind of tech hub Northwest Coast, Seattle and San Francisco markets. LA of the gateways has kind of held out kind of comparatively well. I mean, there's still pretty hefty negative returns there, but it's mainly the Sunbelt metros that have been the more resilient. It's not always the case. If you look at kind of what's been playing out on Phoenix there, and a lot of that is consistent with obviously patterns of kind of office versus remote work, where the Sunbelts have been kind of seen more utilization of that office space. And our research team that I mentioned before have been pulling some analysis together on this from the kind of American Community Survey. So Alex, maybe you just want to pick up on this analysis just as a quick kind of soundbite.
Sure. As Phil mentioned, our research team has been looking at a number of different data sources. This data comes from the US Census American Community Survey, which is performed every year. You'll note 2020 is excluded for COVID and health reasons. The data wasn't collected, but all other years the data is collected. And what we're showing here is by MSA, the percentage of workers that are remote employees in those markets. So in 2019 in San Francisco, 7.2% of the workforce was fully remote. That number then increased in 21 to 35%. And then in 22, it declined to 27%. And so you can see different trends by market. And again, this speaks to the challenges in office. But I think one of the items we look at is pre-pandemic, or in 2019, all markets had less than 10% of the workforce across the bottom that was fully remote. And now in 22, all markets are greater than 10% remote in these different MSAs. So it shows you the impact, the shift, potential obsolescence in a lot of these office buildings just because of this shift that we're seeing in the workforce. Now, the caveat here is this data only categorizes fully remote. It does not categorize hybrid workers. So if there's a 3 days in office, 2 days remote, or some similar version, it's not captured here. But I think it demonstrates the significant shift we've seen in demand for office space across all MSAs.
Yeah, thanks, Alex. I mean, it certainly plays to the challenges, and we're seeing it in the performance numbers that are coming out of San Francisco and DC, which have seen some of the more recent larger write-downs. And I guess that hybrid piece is kind of buried in, when you look at something like New York, which is obviously still experiencing some of the larger setbacks, but maybe more of that connected to the hybrid space. But hopefully that's helpful to share with everybody. Thanks for your kind of running through that, Alex, there. In terms of the actual performance levels, we've taken our interpretation of the office sector one stage further and broken markets, as we're illustrating here, down into what's termed high, medium, or low risks. And we're also separating out the life science and the MOB proportion of the office sector. Just to explain how we're arriving at the high and the medium and the low risk, this is bracketing based on occupancy, as the legend says, and lease term. And if you've got shorter leases, are they located in what's being identified as some of the more challenged markets based on the historical performance numbers. So in terms of the weights, based on this classification, and it's just a way of getting a sense of the relativities. 30% of the office market is therefore classified as high risk, 50% medium risk, and within that medium risk you can have dark to light shaded orange, I'm assuming, and then you've got 10% which is low risk, where there's more than 95% lease and over 7 years left on the term, and then you've just got about over 10% of the office market, and that's important to note, is either life science and MOB. NCREIF are clarifying this kind of categorization, and we'll be able to kind of get kind of pure around this. But hopefully, as you can see from those bars to the right-hand side, there's a clear step relationship in terms of the appreciation levels, and these are appreciation levels over the last 4 years. So those life science assets have really been pretty stellar in terms of a 30% increase in values, and you've got that high risk top there where values are down by over 40% over a 4-year time frame. If we then take it one stage further and we separate out the kind of the high, medium, and low risk assets within each metro where sample sizes permit, and again based on lease and occupancy thresholds, looking at these, what are 4-year valuation movements, it really serves to illustrate just how much of a range of results sit within the office sector at the moment. I mean, the high risk are unsurprisingly the ones at the bottom of the stack. You've got more than 45% value decline there. San Francisco and DC high risk. Of the New York high risk, they're losing over half their value over the last 4 years. Medium, kind of the medium risk brackets, you've got kind of Chicago and New York sitting at the lower end, no surprise there. If you look at the kind of blue bars, that's the overall value decline for traditional office, which I think I wrote down before, is just over 31%. You can see how that is kind of partly being propped up by some of the more medium risk and also that kind of low risk bracket where value decline is still low single digits over the last 4 years. The totality of office market, which includes the life science and MOBs, is a little shade better off, so you can see how that kind of props up the order a little bit more there. So, but hopefully interesting to see just the totality of the spread that's there, and we'll obviously be providing this analysis when we talk to our clients on a comparative basis. Anything to add on that one, Alex, or should we roll? Just look at the clock. We got time, but we could roll to the retail sector.
I think keep moving to the retail sector. As Phil mentioned, we are having a lot of dialogue with our clients on office, but want to make sure we allow time for questions on this.
Okay, so let's just finish off with the retail sector here. 4-year outlook, annualized numbers. Really kind of two sides to the retail sector. At the lower end, you have the malls, and you partly maybe include the fashion and specialty centres within that. Versus the rest, you've got your neighbourhood centres, your power centres, and community centres that higher up the stack there. The community centres, the traditional kind of grocery anchor centres, certainly proved their worth during the pandemic and have since sustained quite a lot of that elevated foot traffic. Then you have at the upper end the neighbourhood and the power centres, both of which folks will remember lost a lot of ground to the growth of the online retailers between, say, 2015 and 2020. But a number of these have really since been kind of reinventing themselves as hotspots for that kind of furthermore quick growing offerings in that kind of discount retailing space, and they're starting to see a little bit more upward progression in their cash flows. This is the type of analysis that I was saying was coming out of those research reports. So interesting to see how that is playing out in the numbers. More acute kind of price discovery down the bottom here for the larger malls, and with kind of further reductions in cash flows. Alex, any thoughts you have around these variances that we're seeing?
So the other positive note we've seen, or we're starting to pick up as you're showing in the data, Phil, is on neighborhood, power, and to some extent in community centers, we're seeing the cash flows strengthen. And I think that's a product of two items. One is if there are percent rent clauses in any of the leases or other income. If you're a food retailer, if you're a clothing retailer, prices are certainly up from where they were 1, 2, 3 years ago. And so those percent rent leases or clauses are increasing the NOI or cash flows. So that's number one. And then I think the second thing for all three of those subtypes, those are part of the positive impact from remote work or hybrid or more suburban shopping. And so they have had positive influences from shopping activity on Mondays or Fridays that were traditionally done in urban areas, but are now being done in suburban areas. So I think there's a number of positive areas or green shoots in the retail sector, and we're really seeing that come through in those first three property types or subtypes.
Thanks, Alex. And finally, just for the retail sector, just looking at the 1 year, I think the one thing that just stands out for me for the 1 year is that kind of positive cash flow effect across all subtypes of the retail sector. Rent growth rates kind of ticking back up, and we're definitely seeing kind of more of a positive spread between those market to contract rents, which hopefully kind of bodes well for the sector. But yeah, we've done 50 minutes of chat, so hopefully that's not too much there for folks, but hopefully it's helpful just to go through all of that. One final polling question, but I know there's most probably stuff that's come through the chat wire, so let's take this one and see what questions have been asked. And if we don't get to all the questions, we'll obviously narrate them through and send them back to people afterwards.
Sure. So the last question, and it's the same question we started with, but now for fourth quarter, is what is the expected total unleveraged property return to be in 4Q23? Do we expect positive value movement for Odyssey as a whole? Do we expect it to be slightly negative? The second choice, do we expect it to be more negative, -4, or between -4 and -2? Or do we expect it to be significantly negative, -5 or greater? So again, just want to get a sense for what our audience is anticipating or thinking about the return for fourth quarter total unleveraged property return. So with that, do we have the results tabulated yet? So it looks like, Phil, the majority are anticipating a similar value change or negative return. 53% voted between -2 and +1, and then 40% voted between -4 and -2. So we'll bring this up at the beginning of the next webinar and see how we did for a forecast for 4Q.
Yeah, so maybe we should go straight to any questions that have come through there, Alex. So, I mean, the conclusion points, people can read those at their leisure. And recordings of this deck will be sent out as well.
So, Phil, we've received a few questions. The first question, one of the first ones that came in, was around the impact of returns for allocation versus selection. Do you have a sense, or have we quantified what impact is associated with the allocation effect versus what impact is associated with the selection effect in the current environment?
That's one slide I kicked out the deck. So yeah, and we'll put it in the deck when we send it around. It has become there's a little bit more of an allocation tilt. The long run average is about 30-70, and we're pretty much spot on that at the moment. I mean, it reached about 50-50. Allocations versus selection when you're just thinking of allocation towards individual sectors when you've got that kind of upswing in the growth period, but it's down to about about 30-70 now. 70% selection has crept up a little bit, I guess, with the office market now being cast adrift for a couple of quarters. One of the other things I got asked the other day, just tagging onto that, is that within the selection effect, then how much of the selection is driven by people's performance variances within the office sector, given that office is such a hot topic at the moment in terms of on the decline. And of that kind of 70% influence on return variance that's come from how you perform within the individual sectors, looking across these portfolios, it's a third towards apartments, kind of offices, and on the industrial side. So it's not just the performance variances in the office sector, it's performance variances that are playing out in the other sectors as well that are influencing that. So yeah, we'll put that slide back in the deck when we send it around. But yeah, there's a lot more to it. And obviously when you're talking about selection, there's an allocation within the sectors towards specific geographies and types. So there's a lot of property specifics that are playing out.
Okay. Phil, another question we got was around the dispersion of returns. I know the data we have presented are averages or split by MSA or product type, but do you have a sense of the dispersion of returns or the different portfolios across the fund managers?
Right, across the fund managers. So yeah, I mean, similar to the fact that we're seeing kind of convergence across the sectors to a certain degree, we are seeing some degree of convergence across the across the individual portfolios. I think, that point when we got double-digit spreads around that kind of growth period between the industrials versus the rest, spreads around about 7% for quarter, I think, across the portfolios. That's closed in, I know, to kind of sub 3 now across the portfolios that we've got visibility into. And part of that is dictated by the order of magnitude of the return. That the larger the return level on the up or the downside, you could expect a bigger spread. But but I think there's more to it. You've got convergence of returns a little bit more across the sectors, so that allocation piece is less kind of pulling portfolios apart. But also, to the themes that we picked up today, the fact that we've got a bit of a shake-up started to come through on the apartment sector. It's not so clear-cut, Sunbelt versus Gateway. That all plays towards a little bit more convergence as well. And we've certainly seen a bit more of a narrowing in terms of the performance levels across the portfolios. Hopefully that's what we're after.
Perfect. And Phil, one other question that came in. We do have a number of other questions. We can absolutely get back to those, but we want to be cognizant of time as well. A question that came in before the webinar was, how do the current returns compare to financial crisis? So looking at the current time period versus back to, call it 2008, 2009, are there similarities? Are there differences? And so answering it from a valuation standpoint first, and then Phil, I'll pass to you. I know we've looked at some returns. I think the primary difference we see now versus GFC is that the fundamentals are behaving much differently now than they were 2008, 2009. I will leave office aside. Again, I think office is going through a significant change, as we've shown in some of the charts. But as a general statement, the demand for industrial, for retail, for apartment has held up or been relatively resilient. And so I think that's a real fundamental difference in that there was positive cash flow movement, as Phil has shown, versus 2008, 2009, where it seemed like the entire market was under pressure, both from fundamentals and from an investor yield standpoint. So Phil, pass to you.
Yeah, and just to put some numbers around that, I think we had 8 quarters of declining value when it comes. Well, if you just talk to maybe the office market, and we pulled this data from the NPI query tool, so 34% write down over 8 quarters through the GFC on offices, and we're currently looking at a 31% write down over, well, primarily the last 5 quarters, but there were some prior quarters at the start of the pandemic. So 31% write down for now versus 34% through the period of the GFC for the offices. And if you think of the answers on those questions, then you'd expect some more downside coming through on the offices. So and to your point, Alex, different set of circumstances, fiscally, economically being played out, but also in terms of the kind of the strategic thinking with regard to the individual sectors. But hopefully they're going to get a couple of levels there to put out there.
So Phil, I know we're at the top of the hour. We do have a couple outstanding questions, but we can definitely follow up with those participants and get back to them on their specific requests or comments.
Excellent. Well, thank you, Alex, for guesting in today. Been great hearing your commentary and your comments around the numbers. Really appreciate that. Special thanks for everybody that's dialed in today. Any interest you've got around this information, the comparative side of the data that we can pull together, please do get in contact with your kind of your lead contact within Altus, or come certainly straight through to Alex or myself. But yeah, thank you very much for everyone for dialing in. Have a good rest of the week, and we'll see you again next quarter. We'll be posting the date for that online, which I'm just looking at my own calendar. I should have had this one to hand for next time round, but that will be on Thursday, the 8th of February, if people want to put that into their calendars now. But thanks for your time today. Have an enjoyable rest of the week.